Thank you very much to give me the floor. Ladies and gentlemen, dear colleagues, good morning and good afternoon, depending on where you are. It's a real pleasure to be invited by my friend, Mr. Alaa El-Zoheiry, the President of FAIR and Managing Director of GIG Egypt. It is also my pleasure to meet all the distinguished insurance and reinsurance practitioners and leaders in the Middle East and North Africa MENA market, particularly those who have been or will be speaking to us. Going straight to our session's topic entitled, Will the Reinsurers Really Withdraw, and Who Will Pay for the Disagreement? Client, insurer, and all reinsurers. I need to highlight 2 points at the beginning of my remarks. The first one is usually setting what will be the reinsurance strategy is for the whole industry a great challenge, as every reinsurer has to look at multiple factors and parameters to make its decision. There are issues around geographical scope, diversification strategy, exposure on catastrophes, losses, the underwriting result versus investment result, the risk appetite, especially in terms of return on equity and cost of capital. These multiple parameters, which dictate whether an insurer remains or not in a market, are not straightforward. There is not yet a computer or artificial intelligence or algorithm to guide reinsurance companies' management and board of directors in this. Hard facts, experience, and intuition, sometimes drawn from conferences like this, must be combined in the decision-making process. That's why our industry is really interesting. The first point I want to make is that we have to differentiate between physical withdrawal from a market in the sense of operational and functional presence in that market, and partial or total withdrawal of capacity, which is basically to stop to write business from a given market. For example, Africa Re has opened its office last year in Dubai, so that is a physical entrance. And before, we had to restrain our capacity for multiple reasons, which we know all of us as reinsurers and we share, being the losses on the bottom line, which were unbearable according to our risk appetite. And indeed, in recent years, we noticed a remarkable physical withdrawal of international reinsurers and Lloyds from GCC countries, while they moved their functional functions and the operation department in other places like Europe and the UK. And similarly, though on a lower case, other reinsurers stopped underwriting business in the MENA region due to bad performance. Dear colleagues, coming back to the topic of my intervention, my view is that we will see stability in the international and regional reinsurance presence in the MENA region, as well as stability in the provision of underwriting capacity. And therefore, I don't see any expected gap coverage in the GCC market in the 2 years to come. We believe that local, regional, and international insurers will step up and provide the necessary capacity and covers to the current, due to the current hardening of the reinsurance market in 2020 and in the first semester of this year, 2021, both at the global stage and the regional stage. Beside the reinsurance market hardening, there are not much growth in surrounding national and the regional markets, where to drive the flow of business much needed to support the all-time high level of capital detained by most of insurers and the reinsurers of the region. Of course, some questions will remain, questions which could lead to a timid commitment to the GCC market. These questions are the sustainability of the increase of market rates going forward, the level of catastrophic losses worldwide, and finally, the growing inflation rates and their impact on losses. As demonstrated by many recent market surveys, most of analysts believe in a continuous hardening of the insurance and the reinsurance market. And if anything else, for the uncertain world we are living in, a world which until recently was called VUCA, meaning volatile, uncertain, complex, and ambiguous, and now is called BANI, which means brittle, anxious, non-linear, and incomprehensible. COVID, of course, is there to emphasize all this, including the digitization of all the processes of our lives. Today, it is believed or feared that COVID-19 pandemic fallouts have not been fully unfolded, both socially, economically, and politically. The rising inflation is one which is yet fully to be understood, especially if it will stop somewhere in 2022 or if it will continue as it was after previous historical world economic shocks. When you add to that the potential impact of climate change on some classes of business, business, there is a reason to remain prudent in the risk underwriting and rather be bullish in building up resilience, especially when the worst will happen. For the global insurance outlook, I believe that bearing above average insurance catastrophes, the time of continuous industry average combined ratio above 100% is over, at least for the next 3 years or so. This is attested by all the rating agencies which have put their industry outlook at stable, and this after many years of negative outlook. During the first semester of this year, for example, Africa Re achieved a 7.2 growth in US dollars terms, with almost the same portfolio and exposure as in the recent past. Certainly the reason behind that is the hardening we see across most territories and most lines of business. On the bottom line side, the underwriting performance had followed suit with an improved combined ratio of 95% compared to 98% of last year. Ladies and gentlemen, dear colleagues, in the Middle East and North Africa region, the trend is similar, characterized by a sharp improvement of price and terms and conditions from insurance, reinsurance, all the way to the retrocession market for the first time in years. This had to happen anyway. Practitioners and analysts for years have been asking themselves when the correction will happen, from which trigger, and at which degree of adjustment towards risk price adequacy. Should the situation has continued for long, we would be counting who next will stop writing business from the MENA region, who next will be downgraded, whether the withdrawal of capacity will be something of a greater impact on the prices. However, though the hardening trend continued in July 2021 renewals, and particularly for loss-affected accounts, some pockets of business remained underpriced. The best example is the facultative business, whose rates remained unchanged or below the economic price. The culprits are notably the well-capitalized primary insurers in the MENA markets who continue to support inward facultative business on an opportunistic basis. Our prediction for the MENA region is that only the level of investment returns in the financial markets will drive the behavior of many players to sanity. The better the performance of financial markets, which allow overcapitalized market players to remunerate recently their shareholders, the shorter will be the positive pricing trend to correct and improve our technical performance. Finally, for the MENA region, we should not think that all is determined by insurers and reinsurers' expertise to adequately price the insured risks. A lot depends on the external factors, among the most important being, first, the global catastrophe claims cost for 2021, including the COVID-related claims and their impact on the retro costs. Second, the perceived impact of climate change on the ultimate claims costs in the years to come. Third, the level and length of inflationary pressures. And fourth, the average level of interest rates. In concluding my remarks, I would say the following in response to the topic's discussion. Will reinsurers really withdraw? My response is no, at least in the coming 24 months, since the outlook is stable and even positive in the eyes of some market players, including Africa Re. On the second question, who will pay for disagreement? My response is the one who thinks that he can win for some times where others have lost for so long without adjusting his pricing and imposing adequate terms and conditions. In my opinion, people who think like that may be found more among local insurers than among reinsurers, since our industry, especially in the MENA region, has seen many players having tremendous difficulty in terms of rating, in terms of profit, and so on. Frankly speaking, I don't see insurers continuing to walk the same way in a field full of dead and wounded peers. As for Africa Re, I would say on a lighter note, by quoting Otto von Bismarck, I quote, "Fools say that they learn by experience. I prefer to profit by others' experience," end of quote. Ladies and gentlemen, I hope my intervention has contributed to shed some light on the complexity of the reinsurance industry and its dynamics. I remain with you to answer questions which will come from the floor or from the audience. And I thank you for your kind attention. Thank you.